India and China, Asia's giants, are bound by a complex mix of rivalry and economic interdependence. Their relationship is shaped by centuries of history, cultural ties, and a shared ambition to lead the region. Yet, beneath the surface, competition and cooperation are constantly at play. Despite frequent border disputes and deep-seated mistrust, their trade relationship stands as one of the world's most significant, influencing not just their own economies, but also the broader Asian landscape. China is among India's largest trading partners, shaping India's industries, consumer markets, and even the technology that powers daily life for millions of Indians. This relationship is a paradox. It fuels India's rapid economic growth, providing affordable goods and vital components, but also creates vulnerabilities that can't be ignored. One of the biggest challenges is a persistent trade imbalance, with India importing far more than it exports. India exports mostly raw materials to China, such as minerals, cotton, and agricultural products, which are essential but low in value. In return, it imports a flood of finished goods, electronics, machinery, and everyday products, highlighting their different roles in the global supply chain and the value addition gap. The trade is dynamic, constantly shaped by shifting policies, tariffs, and the ever-changing landscape of global geopolitics. Recent diplomatic efforts and high-level meetings show both nations recognize the necessity of economic engagement, even as tensions simmer in the background. For India, the challenge is to benefit from this relationship, harnessing opportunities for growth, while also working to reduce over-reliance and build self-sufficiency. Understanding this intricate economic dance is key to grasping not only the future of India and China, but the future of Asia itself. India's exports to China are dominated by raw materials, iron ore, cotton, copper, and chemicals. These commodities form the backbone of India's trade relationship with its northern neighbor, representing the first step in a long global supply chain. These resources feed China's vast manufacturing sector, reinforcing India's role as a supplier of basic inputs. Every year, millions of tons of these materials cross borders, fueling the relentless pace of Chinese industry and production. Indian cotton becomes Chinese textiles, and iron ore becomes steel for global markets. The transformation adds significant value, with China exporting finished products worldwide, while India's contribution remains largely at the raw material stage. Even marine products like shrimp find eager buyers in China. From agricultural produce to seafood, India's natural resources are in high demand, supporting livelihoods back home but rarely capturing the highest profits. However, these exports are low on the value chain, fetching lower prices than the finished goods India imports. The real value is added after these materials leave Indian shores, as China turns them into high-tech electronics, machinery, and consumer goods. This imbalance is a core reason for India's trade deficit. The gap between what India exports and what it imports from China continues to widen, raising concerns among policymakers and industry leaders. The challenge: India must move up the value chain, exporting more processed and high-value goods. Only by developing its own manufacturing capabilities can India hope to capture a greater share of global profits. Achieving this requires investment in technology and manufacturing to compete with China's industrial might. With innovation, skill development, and strategic planning, India can transform from a supplier of raw materials to a powerhouse of finished goods. India's imports from China are overwhelmingly finished, high-value goods, electronics, machinery, and more. Chinese smartphones, computers, and components dominate Indian markets, powering both daily life and industry. Even India's push for manufacturing relies on Chinese equipment. Strategic sectors like solar energy and pharmaceuticals are deeply dependent on Chinese imports. For consumers, this means affordable products. For Indian manufacturers, it's fierce competition. The result: a dependency that's hard to break, and a competitive gap India is eager to close. Reducing this reliance is now a top priority for policymakers. The defining feature of India-China trade is the massive growing deficit, nearly $100 billion in 2024-25. This gap has widened steadily over the past decade, making it a central issue in economic discussions between the two countries. The numbers are staggering and highlight a persistent challenge for India's economy. For every dollar India exports, it imports almost 8 from China. This means that Indian businesses are sending out far less than what is coming in, creating a lopsided trade relationship that is hard to ignore. This reflects India's export of low-value goods and import of high-value products, highlighting a technological and industrial gap. While India often exports raw materials or basic goods, it imports advanced electronics, machinery, and components from China, deepening the divide. The deficit is fueled by India's demand for electronics and machinery, and its own manufacturing limitations. Indian factories often lack the scale, automation, and technology to compete with Chinese manufacturers, making imports almost inevitable. As India's economy grows, so does its appetite for Chinese goods. Everyday products, from smartphones to appliances, are dominated by Chinese brands, reflecting their strong presence in Indian markets. This imbalance pressures India's currency and raises concerns about unfair competition and dumping. Many worry that cheap Chinese imports could undermine local industries and threaten jobs, sparking debates about fair trade. The government faces mounting pressure to support domestic industry and rein in the deficit. Policymakers are exploring new strategies, from tariffs to incentives, to encourage local manufacturing and reduce dependency. Closing the gap requires boosting competitiveness and reducing reliance on Chinese imports. This means investing in innovation, upgrading technology, and empowering Indian entrepreneurs to create world-class products. The trade deficit is both an economic and strategic challenge for India, shaping not just business decisions, but also the country's position on the global stage. After years of tension, India and China have cautiously resumed diplomatic engagement. High-level meetings like the 2024 BRICS Summit and the 2025 SCO Summit signal a desire to stabilize ties. Direct flights have resumed, making business and people-to-people exchanges easier. Leaders' rhetoric has softened, and India is considering easing curbs on Chinese investment. Yet, core disputes, especially the border, remain unresolved. The diplomatic thaw is pragmatic. Manage tensions, keep economic cooperation alive, and seek a more balanced relationship. India's future with China depends on balancing deep economic ties with the risks of dependency. Decoupling isn't realistic, but India is moving to protect its interests, monitoring imports, guarding against dumping, and supporting domestic industry. Initiatives like the Production-Linked Incentive Scheme aim to boost manufacturing in key sectors. The goal: substitute imports, build capacity, and eventually compete with China globally. Trade with China remains vital for growth, but vulnerabilities must be addressed. The unresolved border and trade imbalance demands sustained attention. India's strategy: engage economically where beneficial, but build domestic strength to reduce risks. Mastering this balancing act is a defining challenge for India's future.